Ever wondered how the stock market works? Today we're going to demystify this seemingly complex entity and break it down into simple terms. Think of the stock market like a bustling marketplace. But instead of buying and selling fruits or clothes, people are trading shares of companies. Now you might be asking, what exactly are these shares? Well, shares represent ownership in a company. When you buy a share, you're essentially buying a piece of that company. You become a shareholder, an owner, no matter how small your piece may be. So why does this market exist? The stock market plays a crucial role in the economy. It's a place where companies can raise money to grow and expand. When a company decides to go public, they sell parts of their ownership, their shares, to the public. This sale is called an initial public offering, or IPO for short. The money raised from this sale is then used by the company to invest in new projects, hire more staff, or research new products. But it's not just about the companies. The stock market also provides a platform for individuals and institutions to invest their money. By buying shares, they're hoping that the company will do well and that the price of the shares will go up. If that happens, they can sell their shares for a profit. Of course, there's a flip side. The price of shares can also go down, which could lead to losses. But that's a topic for another scene. The stock market is also a barometer of economic health. When share prices are going up, it often signals that companies are doing well, and the economy is healthy. Conversely, when share prices go down, it could signal trouble. So, now you know that the stock market is a marketplace where buyers and sellers meet to trade company shares. It's a vibrant, dynamic place filled with possibilities and risks. And it plays a crucial role in our economy, from helping companies grow to providing investment opportunities for individuals and institutions. But what exactly are these stocks everyone's talking about? Well, let's break it down. A stock represents a share in the ownership of a company and constitutes a claim on part of the company's assets and earnings. Think of it as a slice of the company's pie. When you buy a stock, you're essentially buying a piece of that company. You become a shareholder, which means you now have a stake in every asset and every penny the company earns. Now there are two main types of stocks: common and preferred. Common stock is, well, common. When people talk about stocks, they are usually referring to this type. Common shareholders have the potential to make the most money because they get voting rights in the company and may receive dividends, which are a portion of the company's profits distributed to shareholders. However, if a company goes bankrupt, common stockholders are the last to receive any remaining funds after debtors and preferred shareholders. On the other hand, preferred stockholders have a higher claim on the company's assets and earnings. This means if the company pays dividends, preferred stockholders get paid before common stockholders. And in the event of bankruptcy, they're ahead in line. But there's a trade-off. Preferred shareholders usually don't have voting rights in the company. So, in the grand scheme of things, stocks are more than just numbers that go up and down on a screen. They are a piece of a living, breathing company. They represent a gamble on the success of a business venture, a bet on entrepreneurship and innovation. Whether you hold common or preferred stocks, you are part of the company's journey, sharing in its successes and bracing for its failures. So when you buy a stock, you're essentially buying a piece of a company. Interesting, isn't it? Have you heard about the Dow Jones, Nasdaq, or S&P 500? These are known as stock market indices, and they play a critical role in understanding the overall health of the market. So, what exactly are stock market indices? Think of them as thermometers for the financial world. They measure the temperature of the market, letting us know if things are heating up or cooling down. When you hear someone say the market is up today, they're often referring to one of these indices. Each index represents a basket of different stocks chosen to represent a specific segment of the market. For example, the Dow Jones Industrial Average, or simply the Dow, consists of 30 major US companies. It's a good indicator of how large corporations are performing. The Nasdaq, on the other hand, contains a heavy concentration of technology companies, making it a good barometer for that sector. The S&P 500 is broader still, comprising 500 of the largest US companies, providing a wide-angle view of the market. How are these indices calculated, you ask? That's a great question. The calculation involves the share prices of the included companies, often weighted by factors such as market capitalization. This results in a single number that moves up and down, reflecting the overall performance of the stocks in the index. So, these indices give us a snapshot of how the market or a segment of the market is performing. Now, you might be wondering, how do I buy or sell stocks? Well, let's break it down. First off, you need a broker. A broker is essentially a middleman between you and the stock exchange, which is where stocks are bought and sold. Think of a stock exchange as a marketplace, but instead of buying apples or oranges, you're buying shares of companies. So how do you choose a broker? There are many factors to consider. Some brokers charge commissions on trades while others don't. Some provide additional services like financial advice or research reports, while others are more bare bones. It's crucial to do your due diligence and find a broker that fits your needs and budget. Once you've chosen a broker, you'll need to open a brokerage account. This is similar to a bank account, but instead of holding cash, it holds your stocks. Opening an account typically involves filling out some paperwork and providing some identification. Now that you have a brokerage account, you're ready to start trading. But how do you actually buy or sell stocks? Well, it starts with a decision. You decide which stock you want to buy or sell and how many shares you want to trade. Once you've made your decision, you place an order with your broker. There are different types of orders you can place, such as market orders, limit orders, and stop orders. Each type of order has its own advantages and disadvantages, and it's important to understand these before you start trading. After you place your order, your broker sends it to the stock exchange. The exchange then matches your order with another order that meets your criteria. For example, if you're selling, the exchange will find a buyer for your shares. Once the exchange finds a match, the trade is executed. The stocks are transferred from the seller's account to the buyer's account, and the money is transferred in the opposite direction. And that's it. You've just bought or sold stocks. Of course, there's a lot more to successful trading than just buying and selling, but this is the basic process. So, with the help of a broker and a stock exchange, you can start trading stocks. But remember, with great potential for reward comes great risk. That's the mantra of the stock market. It's a place where fortunes can be made, but it's also a place where money can vanish in the blink of an eye. Let's talk about the risks first. Market conditions are a prime example. They can fluctuate wildly from day to day, and even hour to hour. These fluctuations can be triggered by a slew of factors, everything from political unrest and natural disasters, to changes in industry trends and corporate earnings reports. When the market conditions are unfavorable, stock prices can plummet, and you can lose a significant portion of your investment. But it's not all doom and gloom. With risk comes the potential for reward. The stock market has proven to be a lucrative investment avenue for many. When market conditions are favorable, and you've done your homework on the stocks you're investing in, you could see substantial returns. Imagine you've invested in a startup that suddenly takes off, or a steady Eddie blue chip that consistently performs well. In these scenarios, the value of your stocks could skyrocket, multiplying your initial investment many times over. So, while the stock market can offer significant rewards, it's important to understand and manage the associated risks. Because in the world of stocks, risk and reward are two sides of the same coin. So, are you ready to dive into the world of stocks? We've taken quite an enlightening journey today, haven't we? We've peeled back the layers of the stock market, starting with understanding what it is and how it operates. We've examined the nature of stocks, the building blocks of the market, and explored the significance of stock market indices. We've also delved into the practical aspects of buying and selling stocks, and highlighted the risks and rewards linked to this thrilling world of investment. It's clear that the stock market isn't just a game of chance. It's a field that requires knowledge, strategy, and a good dose of patience. The importance of understanding the stock market before stepping into it can't be overstated. It's not just about making money, it's about making informed decisions, understanding the risks, and knowing how to navigate the highs and lows. Remember, knowledge is power, especially when it comes to the stock market. Invest wisely.